All right, welcome to the Explainer. Today we're tackling a really fascinating question that a tax advisor got from their YouTuber client. So, what's the plan? Buy a $3 million mansion, call it a studio, and try to wipe out a huge chunk of their taxes? I mean, it sounds almost too good to be true, right? So, let's dig in and see if this is a genius move or just a massive, massive gamble. Okay, so let's get right into the exact question that was asked. And you got to pay attention to the language here. Beat the shit out of that profit. You know, this tells you everything. This isn't some gentle tax-saving measure. This is an all-out aggressive plan to use a mansion as a production studio to create gigantic tax write-offs. Our job here is to figure out if a plan this audacious could actually fly. And that really gets to the heart of it, doesn't it? Is this a brilliant, totally legit way to structure your business and save a ton on taxes? Or is it the kind of thing that's going to paint a giant target on your back for the IRS? Let's figure it out. Okay, first up, the anatomy of a tax plan. So before we talk about all the things that could go wrong, we really need to understand how this whole thing is supposed to work on paper. The setup itself is actually pretty slick. You create two different companies, but you control both of them. Your YouTube corporation pays rent over to your property LLC. That rent payment becomes a business expense. Boom! That lowers the corporation's taxable income. At the same time, the LLC that gets the rent money uses these huge non-cash deductions to make that income basically vanish, at least for tax purposes. So the first big weapon in this arsenal is something called accelerated depreciation. And thanks to some recent tax law changes with 100% bonus depreciation, a business can write off, get this, potentially the entire cost of certain things in the very first year. We're talking about a massive deduction right up front, which is totally key to this whole plan. Now, you combine that with cost segregation. And this is a super interesting strategy. You literally hire a team of engineers to walk through the property and pick it apart, identifying every little thing that isn't, structurally part of the building. And why do you do that? Because all that stuff can be written off way, way faster than the house itself. And this slide gives you a perfect idea of what we're talking about. Think about a YouTube studio mansion. We're not just talking about the walls, we're talking custom lighting rigs, special wiring for all your cameras and computers, soundproofing, security systems, maybe even those cool movable walls for different sets. All that stuff, instead of being stuck on a 39-year schedule with the building, could potentially be written off in just 5 years. That's a huge difference. All right, Section 2, when you rent from yourself. Now, this all sounds fantastic, right? Like you've cracked the code. But, and this is a huge but, the whole thing hinges on one tiny detail. You're renting from yourself. And that introduces the related parties problem, which is where the IRS gets very, very interested. Yeah, there's a name for this. It's called a related party transaction. And because the same person owns more than half of both companies, the IRS doesn't see this as a real deal at all. It's you moving money from your right pocket into your left pocket. Just think about it for a second. In a normal deal, what they call an arm's length transaction, you've got two people on opposite sides of the table. The landlord wants the highest rent they can get, the tenant wants the lowest they can pay. And somewhere in the middle, they find a fair price. But here, in this setup, that tension is completely gone. There's no negotiation. You can just make up a number for rent that gives you the biggest tax break. And the IRS knows that. And look, this isn't some big secret. As legal experts will tell you, the IRS literally trains its agents to hunt for these exact scenarios. They're actively on the lookout for people who are using these self-dealing leases to basically invent deductions out of thin air and unfairly lower their tax bill. Okay, so Section 3, the IRS red flags. So let's get really specific here. What exactly is going to make an auditor's alarm bells go off when they see this tax return? The way the IRS looks at this is pretty simple. They don't see two companies. They see one single economic unit, you. And from that perspective, they start hunting for what they call abuse transactions. And that's just a fancy way of saying deals that have no real business purpose other than to dodge taxes. And red flag number 1, the very first place they're going to poke around is the rent. Is the rent your YouTube company is paying your property LLC a real, honest-to-goodness fair market price? Or did you just pull a big number out of a hat to get a bigger deduction? And if an auditor decides that rent is way too high, they don't just ask you to fix it. Oh no, the tax code has a special little punishment for this. That excessive portion isn't treated as rent at all. They reclassify it as something called a constructive dividend. And that's basically IRS speak for nice try. That wasn't a rent payment. You were just paying yourself profits from your company and trying to call it an expense. And here's the kicker. Dividends aren't deductible. So poof, the entire tax deduction you were trying to create just vanishes. All right, red flag number 2. And honestly, this one might be even bigger. The client is swearing up and down they're going to use this $3 million mini mansion only for business and keep living in their condo. You think the IRS is going to believe that? Not a chance. They're going to be extremely skeptical. See, there are super strict rules about using a property for personal stuff when you're also trying to claim business deductions on it. It's called the 14-day rule. And basically, if you so much as crash there for more than 2 weeks a year, you completely lose the ability to claim a big tax loss. And this is absolutely huge because it completely guts the entire plan. Remember, the goal was to wipe out a good chunk of my taxes? Well, this rule says, nope, your deductions can only cancel out the rent income. And that's it. You can't use them to offset your other YouTube income. And then there's red flag number 3. This is kind of the IRS's ultimate weapon. It's called the economic substance doctrine. And this is a really broad but powerful rule that basically says any business deal has to have a real point to it other than just saving on taxes. And if a judge looks at this whole mansion rental shell game and decides its only purpose was tax avoidance, they can just wave a hand and make the whole thing disappear. And you know what would be Exhibit A in that court case? The client's own words. Beat the shit out of that profit. Not a good look. And feeling this test is brutal. It's not just about paying the taxes you originally owed. It comes with a monster 40% penalty. And strict liability means you can't argue your way out of it. It's automatic, on top of the back taxes, on top of the interest. Ouch. So that brings us to our final section. Strategy or house of cards. After looking at how it's supposed to work and all the ways it can blow up, what's the final call on this YouTuber's big idea? If you get audited, it's all going to come down to these questions. It's about substance. Does this whole thing actually look and feel like a real business deal you'd make with a stranger? Is there a real lease? Is the rent comparable to, other actual production studios in the area? And maybe the biggest question of all, does a YouTube channel really need a $3 million mansion to film videos? And that really brings us to the bottom line here. Look, every piece of this puzzle on its own is a perfectly legal tax tool. Cost segregation? Legal. Accelerated depreciation? Legal. But when you jam them all together inside this kind of related party lease with a super expensive residential property that you're claiming is 100% business, you've basically created a perfect storm of audit triggers. You might as well be sending up a giant flare over your tax return that says, hey, audit me. So in the end, it really comes down to this one question you have to ask the client and yourself. The line between a clever strategy and a complete disaster of an audit is razor thin. It all comes down to substance, proof, and documentation. And with a plan that has this many red flags stacked up against it, you really have to wonder, are the potential tax savings really worth the guaranteed headache and the massive risk of a fight with the IRS that you're very likely to lose?